Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
All right, good morning, everyone. So just one announcement, because Thursday, tomorrow is Anzac Day, so we don't have workshop tomorrow. I've already incorporated workshop in today's lecture. So if your tutorial is enrolled in Thursday's tutorial, please feel free to go to other tutorials this week, right? You don't need my permission. Just go to whichever tutorial that's most convenient to you. Okay, so basically I've uploaded your Miss Mastery exam result on Wattle, so please check that. And also check whether you've got your quiz 1 and quiz 2 mark. If you haven't got your quiz mark, please email me, and I'll trace back what is your mark. And also next week, you'll have a quiz. So next week quiz is on binomial option pricing. Okay, so next week you're going to have your third quiz on binomial option pricing. And also next week, your tutor would give you your script book, your Miss Mastery exam script book, for you to view. Okay? So either your tutor would give you 10 minutes at the beginning, or maybe 10 minutes towards the end, for you to view your exam script book. So you have to attend your allocated tutorial to view your exam script book, right? So if you go to other tutorials, the tutorial that you are not allocating, you will not be able to view your exam script, okay? And while you're viewing your exam script, you cannot have mobile phone, you cannot have tablets, you cannot have laptop, and you cannot taking down notes, right? And you have to return your script book to your tutor at the end of the tutorial. Okay, so that's just some housekeeping stuff. Is there any questions with exam script viewing? Okay. All right, so before we start this lecture, I just want to quickly go through the Miss Mastery exam. I would say Miss Mastery exam is quite straightforward, right? So for example, first question is just taken straight out of your lecture slides, right? So I mean, you've done this in your first quiz. So valuing forward contract. So let's have a look. So this question says, BHP is expected to pay dividends, $3.50. So the first dividend will be paid in 8 months' time, and second dividend will be paid in 11 months' time. And you were told the spot price on BHP share is 37 at the moment. So the risk-free rate is 2.6% per annum compounded monthly for all maturities, and you've decided to take a short position in 15 months forward contract on BHP. So given this information, you're asked to work out what is the forward price and what is the initial forward value. So the only one tricky thing that you really need to worry about is this risk-free rate. So 2.6% per annum compounded monthly, right? So you just need to use this equation you learned from week 2 to convert this monthly compounded interest rate into a continuously compounded interest rate. So that turns out to be around 2.6%. The next thing you need to do is to discount the two dividends back to the present, right? So you're discounting the dividends using this interest rate that you just converted. All right, so discount back the first dividend 8 months and discount back the second dividend 11 months. Then the next thing you do is you have to strip away the dividend from the current share price. So you were told the current share price is 37. So 37 minus the present value of these two dividends, and you bring forward 15 months and using the continuously compounded interest rate. So you'll be getting the forward price is 31.13. Okay, so I think everybody did pretty well in the first part. So the initial forward value is 0, right? So when a forward contract is just entered into, is a value of 0, always 0. Okay, so the second part says 7 months later, the price of BHP is 32, and the risk-free rate of interest remain the same. So what is the forward price, and what is the value of your short position? Okay, again, you still have to discount back your dividends, but this time because that's 7 months later, so the first dividend will be paid in 1 month's time, right? So discount back 1 month, and the second dividend will be paid in 4 months' time. So basically 11 minus 7, so that's so you discount back 4 months, and the same as before. You're using the updated spot price. So the updated spot price for BHP 7 months later is $32, right? So $32 subtract the present value of the two dividends, and you bring forward 8 months, right? So you get the forward price is 25.47. Okay, so you ask to value this short forward. So you're locking to sell at 31.13. Somebody else who entered into this short 7 months later can only lock in to sell for a lower price, 25.47. So this short forward contract must have positive value to you, right? Because you're locking to sell at a higher price. And somebody 7 months later locking to sell at a lower price. So even without calculating, you should know this short forward has a positive value to you. So that's just the difference between 31.13 and 25.47. But you have to discount back 8 months because that cash flow difference happened at date of maturity. And you are valuing this contract today, right? So you discount back 8 months, you realize this short forward contract is valued, has a value of $5.56. Right? So everybody's clear with the first question, right? That's just what we have been doing over past 6 weeks. Second question. So second question, you will ask to design an interest rate swap on investment, not on loans. So you were told Telstra with AAA credit rating and Tesla Auto Group with BBB credit rating. So they both wish to invest $100 million on a 20-year investment vehicle. So Telstra and Tesla Auto have been offered following rate of return on their investment opportunities. So looking at this table, so the highest possible fixed rate of return Telstra can get is 9.6%, and the highest possible floating rate of return that the Telstra can get is LIBOR plus 3.8%. And Tesla Auto, so Tesla Auto has a fixed rate of return 6.2, has floating rate of return LIBOR plus 2.5%. Okay, so basically you were told that the swap bank will take 30 basis point cuts as commission, and the Telstra will receive 65% of the gain, and the remaining gain goes to Tesla Auto. Okay, so same as before. First of all, we draw a table to analyze what is the comparative advantage between Telstra and Tesla Auto, right? So again, first of all, you work out the difference in the fixed rate of return between Telstra and TATS. So it turns out to be 3.4% in the fixed rate of return. And then you work out the difference in the floating rate of return, so that's 1.3%. Then the next step is to work out the difference in the difference, which is 2.1%. Remember to subtract the 30 basis points the swap bank needs to take out as a compensation. So you're left with 1.8% to play around with, right? And remember, Telstra has to take 65% of the gain, so that's 0.65 multiplied by 1.8%. So that's how much Telstra needs to take away, and that's how much goes to Taslotto Group. Okay, then you draw the swap. So in the question you were told what really TAS wants is TAS wants a fixed rate of return, and what Telstra really wants is Telstra wants a floating rate of return. Despite the fact, we still would ask Taslotto to invest in the floating rate investment vehicle because that's where the Taslotto's comparative advantage lies, right? So we're still forcing Taslotto to invest in a floating rate investment project. So Taslotto invests 100 mil. And the highest possible floating rate of return that TAS is ever to get is LIBOR plus 2.5%. So once TAS gets that LIBOR plus 2.5%, Taslotto should be passing that LIBOR plus 2.5 all the way across to Telstra, right? So TAS passing the floating rate all the way to Telstra, and the swap bank don't take a cut from the floating rate of return. Okay, so on the other hand, Telstra by himself, he can get LIBOR plus 3.8%, right, without Taslotto. In other words, Telstra kind of lost 1.3% from his floating rate deal. And remember, Telstra needs to be better off by how much? By 1.17%. So that's 1.17% plus the 1.3% loss from the floating rate deal, which means the Telstra needs to be better off at least by 2.47% to achieve our goal. Then we ask ourselves how much Telstra should be paying a Taslotto. Well, Telstra invests in a fixed rate investment vehicle that provides Telstra 9.6%, right? So the 9.6% needs to subtract 2.47%. So Telstra just needs to pay Taslotto 7.13%. So Telstra paying that fixed rate, and the swap bank take 30 basis point cut, and passing the remaining 6.83% to the Taslotto, and we have an interest rate swap. So again, you should draw a table to analyze what is the end outcome. So you realize the Telstra is better off by 1.17%, and Taslotto is better off by 0.63%. So that sum up to be the total gain of 1.8. I mean, you can do it differently. So I all awarded your marks. If you don't have to stick with this solution, although I told you you have to use the convention we taught in the lecture slides. But even if you improvise a little bit, I still give you a mark for this question, right? I think everybody did pretty well with question number 2. So I think the main issue is with question number 3. I actually went through question number 3, a similar question in week 2, towards the end of the workshop, in week 2's workshop. So basically, in this question, it's a portfolio insurance question. So the question says, today is 1st of April. Over recent years, you've constructed a portfolio that consists of Australian stocks, and it is currently worth $5 million, right? So asset under management in your portfolio is $5 million. Although your portfolio is a well-diversified portfolio, but it doesn't match ASX 200 index. Why? Because you tend to favor banking stocks, which has smaller beta than the overall market. So overall, the beta in your portfolio is 0.3%, which means your portfolio is less sensitive compared to the market portfolio, right? If you have beta of 1, that means your portfolio return mimics exactly the market portfolio, but it doesn't. And what the question tells you is ASX 200 index, which has taken a beating in the last 12 months and is currently trading at 5,400 points. So this is points, 5,400 points, and you are concerned there is another financial crisis just around the corner. And the market will be falling in 6 months' time. So what you decide to do is you wanted to lock in the current value of your portfolio. You want to make sure that your portfolio end up roughly around $5 million, okay? So the instruments available to you is September maturing SPY 200 futures contract. So basically, this is the future contract written on ASX 200. All right? And this futures contract is quoted at 5,427 points. Okay, so I also give you this capital asset pricing model. In the first draft of this exam, I did not give you this formula, but I thought you probably forgot this CAPM formula from your Foundations of Finance, so I still put it there. And also, I wrote a little note to remind you that, remind you from Foundations of Finance, you should know the capital asset pricing model is a static model. What do I mean by that? If it's a static model, it's a single period, one-shot asset pricing model, so all the rates that you plug into the CAPM should not be continuous, okay? Should not be continuous. So the single period rate should be plugged into the capital asset pricing model. A lot of people, the first thing they did is to convert risk-free rate into continuous rate. That's wrong. You shouldn't be converting that because I told you here it's a static model. All right, so the first question says, how many contracts you need to fully hedge your exposure to the market risk? Okay, so to work out how many contracts we need, first of all, we ask ourselves, how much exposure do we have? Okay, so in other words, what is the value to be hedged? So I told you your portfolio is 5 million, right? So the value to be hedged is 5 million. And that needs to be divided by how much per contract is covering. So how much contract is covering? So each contract covering 5,427 points, but that's in points. You have to multiply by $25 to get the dollar amounts. So 5 mil divided by that, but that's with the portfolio with beta of 1. We have a portfolio less than 1, which means we need less contract to hedge our $5 million exposure, right? So we need to adjust for the beta. So we need to multiply by 0.7, and we work out to be 25.8. So that round up to be 26 contracts. A lot of people did not round up to be the nearest whole figure, but I did not deduct your mark. But in the final exam, with the portfolio insurance question, round up to the whole number, okay? So then the question comes down to, should we go long, 26 contract, or should we go short? You're worried about the market decline, right? So you have to think about what position would allow me to make money when market declines. What kind of position? Long or short? It's quite obvious, right? Long or short? What do you think? You did your mid-semester test, right? Yes. Long or short? You're worried the market will decline, and you have this futures contract. Should you go long or short? Short, right? Obvious short. Because shorting the futures, you would make money when the market declines. Simple as that. A lot of people didn't say short, right? So you have to state what position you need to take in that 26 contracts. Okay, so I've given you two scenarios. So the first scenario says on the 30th of September, ASX 200 index indeed dropped to 4,300. And you closed out your future contract position on that day. Okay, so given the beta of your portfolio, the first question is, what is the market value of your portfolio after the market decline? And the second question is, what is the gain and losses on your futures position, on your short futures position, and what is the net worth of your portfolio after combining these two figures? Okay, and also I give you the risk-free rate is 3% compounded semi-annually, and ASX 200 index does not provide dividend yield. Okay, so then that's straightforward. Remember, we short SPY at a price of 5,427, right? So you're locking to sell at 5,427, but remember, that's just the points. You need to multiply by $25, and then multiply by number of contracts that you shorted, which is 26 contracts. So you work out you lock into sell for a price around 3.5 million, right? And also, so that was the price you shorted back in 1st of April. Now, 6 months later, you need to close out your contract. How do you close out your short position? Doing the opposite, right? You go long. So the way you close out your short is by going long. So you're going to long SPY 200. At what price? Remember, this is a 30th of September maturing contract, right? So the contract is maturing on 30th of September. And you're closing out the contract on the same day, which means the SPY 200 price should converge to the spot price, right? So you were told spot price is 4,300. So that's the price that you should be loaning. So you close out the contract by going long, and so you bought at a price 4,300 multiplied by $25 multiplied by the contract size. So you bought at a lower price, around 2.8 million. So you made a gain roughly 700,000, right? So you made a gain of roughly 700,000 on your futures position. All right, so that's just your futures position, but you have to work out how much you lost in your portfolio, right? Because your portfolio has a positive beta. If market declines, then your portfolio declines as well. So to answer that question, we need to find out all the inputs for the capital asset pricing model, right? So going back to your capital asset pricing model, what sort of inputs we need? We need risk-free rate. I told you risk-free rate, 3%, semi-annual compounding, right? Because it's a static model, so all you need to do, take 3% divided by 2. So that's 1.5% for the 6 months. Okay? And that's 6 months later. So you can plug in 1.5% into that risk-free rate. And you were told the beta on the portfolio is 0.7, right? So you have that information in front of you. And then the only unknown thing is just the market return you need to work out. What is the market return over past 6 months? Well, you started with the market index 5,400, right? Now it's fallen to 4,300. So you can work out the return on the market is negative 20.37%. So the market provided return negative 0.2037. So that should be the input that you need to plug into RM, right? So as I mentioned, the risk-free rate is 1.5 over past 6 months, beta 0.3. So that's the negative return on the market portfolio, subtract risk-free rate. So your portfolio declined by a smaller magnitude. So market fallen around 20%, your portfolio fallen 13.81%, right? So your portfolio starts with a value of $5 million. So 5 million multiplied by 1 minus that. So your portfolio end up around 4.3 million 6 months later. Okay? But you shouldn't be upset about it. Why? Because you've made a gain from your futures position, right? So you made a gain roughly around 700,000 from your futures position. Now, if you combine two amounts, your portfolio finished roughly around 500 million 6 months later, right? So the insurance worked. The portfolio insurance worked. Any question on this? No? Okay, so the second scenario says, assume on 30th of September, ASX index, instead of falling, it has risen to 6,480. And still, you need to close out your futures contract on that date. And so you need to work out what is the market value of your portfolio after market increase, what is the gain and loss on the futures position, what is the net worth of your portfolio. So again, you lock into sell at a price of 5,427, and now you need to close out by going long, right? So this time you're buying back at a higher price. So you're buying at 6,480. So that needs to multiply by 25. That needs to multiply by the contract size, 26 contract. Okay, so you're buying back at a higher price, so you actually made a loss, right? So your short futures contract, if market going up, you're losing money on your futures position. You lost 680,000, around 680,000. Okay? Now you need to work out what is the market return over past 6 months. So the market increased from 5,400 to 6,480. So that's 20% increase in the market portfolio. So you plug that into your capital asset pricing model, and your portfolio also increased during the same period, but your portfolio increased by a smaller magnitude because your portfolio has smaller beta, right? So if the market increased by 20%, your portfolio increased by 14.45%, right? So you take the initial portfolio 5 mil, multiplied by 1.1445, so you end up with a portfolio worth 5.7 million. However, you shouldn't be too happy about it because you lost money on your futures position. So if you're combining these two amounts, again, you end up with a portfolio value roughly around 500 million. Sorry, 5 million. 5 mil. So that's the way how portfolio insurance work. Any question about question number 3? Okay, question number 4 is very easy because the first part of question number 4 literally just taken out from your week 4 lecture slide, right? Is exactly same. So I will not go through this question. All right, so if you want to know the solution, go back to your lecture 4 notes. So basically, you set up 2 portfolios, and you compare 2 cash flows, and then you establish the lower bound for this European put option. Okay? So everybody should get full mark on part 1. Part B is also taken straight out of your workshop slides. Basically, what you do is, first you check whether this call option is selling at a price that's lower than the lower bound, right? So lower bounds is your theoretical minimum price this call option should be selling for. And you know how to check the lower bound, right? So the lower bound on a call option is simply the spot price minus the present value of the strike price. So you work out, it turns out to be 5.68, and $5 is lower than 5.68, so we can make some arbitrage profit in this situation because that violates the lower bounds. How do you set up an arbitrage strategy? Well, arbitrage strategy simply, the essence of that is simply buying low and selling high, right? So we think about what is the low here. The low is this underpriced call option. We wanted to buy the call option, right? But as the smart arbitrager, we don't use our own money, we use somebody else's money. How do we finance the purchase of this call option? We finance the purchase of call option by shorting the underlying share, right? So the first position is shorting the share, and you'll be receiving a upfront cash proceeds, $58, and you use the $5 to buy the call option, and you invest remaining $53 to buy a zero coupon bond. Okay, so 6 months later, there's only 2 scenarios can occur. Either the share price finish lower than the strike, lower than 55. If the share price finish lower than 55, you simply don't exercise your call option, right? So your option is out of the equation. You simply let it lapse with value of 0, and then because that 6 months later, you have to buy back the share to return to the stock lender. So you're buying back share at the market price, ST. And at the same time, your zero coupon bonds provide you a payoff 55.72. Right? So what is your net gain if the share price finish lower? Your net gain simply, you sum up this column here, so it's 55.72 minus ST. ST is the market value of the share price. Because we know the ST must be smaller than 55. So we're making a profit that's larger than 72 cents. So that's the first scenario. The second scenario is where the share price finished higher than 55. If that's the case, you can exercise your call option. You're buying the share at a price of 55. That's your strike price. And you're using the stock you just obtained from the exercising call to return back to the stock lender. So you close off your short position. At the same time, your zero coupon bond still provided you a payoff of 55.72. So what's the game here? You sum up this column here, and you get, so the net gain is 72 cents. So that's the arbitrage strategy. We did that in week 4's workshop, exactly same. Okay? So a lot of people ask me, Mars, what is the mean and the median for the mid-semester test? I will provide that information on Walto. So I couldn't remember the median, but the mean for undergrad is around 15.5, I think. The mean for the postgrad is around 18.3. Okay, so the full mark is 25. All right? I'll post that on Walto if you're interested. I'll give you that information. Okay? Overall, I think the exam paper is quite straightforward, especially first, second, and the last question. They just taken from your quiz, taken from your lecture slides. Question number 3, also taken from your lecture. I modified a little bit. The only modification here is you need to utilize some of the knowledge on the capital asset pricing model to work out your portfolio return, and that's about it. Okay. So if you have questions about the mid-semester test, we can talk about it during the lecture break. So any question on that? You can view your exam script next week, all right? You have to go to your allocated tutorial. So now we can have a look at today's lecture. So today's lecture is about options on stock indices and foreign currencies. So today is a continuation of what we have been doing over the past couple of weeks. We've dealt with the lower bounds for the European option. We've dealt with the binomial option pricing. We've dealt with the Black-Scholes pricing formula. And we did Black-Scholes pricing formula in an environment where there is no dividend yield, right? We only introduced the dollar dividend in the last lecture. So the way we take care of the dollar dividend is we simply subtract the dividend from the current share price. Then we're using the clean share price, plug into the Black-Scholes pricing model to work out the option price. That's what we did last week. So in today's lecture, we're going to look at the options that are written on stock index, such as ASX 200. Right? So if you think about what is ASX 200, it's basically a collection of 200 stocks that are listed in Australian Security Exchange. The way we get that 200 stocks is by ranking all the stock listed in Australian Security Exchange by their market capitalization. Right? We rank them every quarter by their market cap. Then we take the top 200 largest stock and we package it and we call it ASX 200. Okay, but remember what's in the index, what's in ASX 200 is there are 200 individual stocks. And what those individual stock does is they provide you dividends, right? But different company would pay shareholder dividend at different point in time. So what happens is that you'll be getting, so if you hold onto those 200 stocks, you'll be getting this constant stream of dividends at different point in time throughout the year. All right? So the most convenient way to express that is to express in a dividend yield. Right? So dividend yield, and the dividend yield is very sticky. So when I say the dividend yield is sticky, I mean they don't change very much. Okay? So why they don't change very much? If you think about an individual stock like BHP, if they provide a dividend, 50 cents per share last year, most likely they're going to pay you 50 cents this year, right? And they don't have incentive to increase the dividends. Why? Why companies don't have incentive to increase the dividends? They don't have a huge incentive to increase the dividends.
There's the option value of the executives' options.
That's the first reason. That's the first reason. And what other reasons? So yes, so if they increase the dividends, then that's bad for the co-option, right?
For shareholders, you pay more income tax.
You pay more income tax, and what's more? If you're the manager, if you want to pay more dividend, you have to make more earnings, right? You're kind of setting up a much higher hurdle for yourself. You're setting up a much higher benchmark for yourself. You have to work a lot harder next year to not only earn at least same amounts as you did last financial year, but you need to earn more to increase the dividend payment. So as manager, I don't want to increase the dividend payment. That just make my life much harder. So that's the reason that the manager reluctant to increase the dividends. Now the manager also don't want to decrease the dividends. Why?
It shows, so it hurts the confidence in the company.
Exactly, it hurts the confidence.
It hurts the forward earnings expectation.
Exactly, hurts the expectation, hurts the sentiment towards the company. So managers, they don't want to decrease their dividends either, right? So it's a very bad signal for the company to decrease their dividends. Very, very rarely you see companies decrease their dividend unless they get into financial distress. So like General Electric, they've decreased their dividends, I think last year and also the year before last year. So it's a very bad signal for companies to reduce their dividends. So for that reason, we should expect the dividends stay constant from year to year. If dividend is very sticky, then the dividend yield also has pretty good predictability going forward. So what we can do, we can use the observation about dividend yield on ASX 200 in the past, and we can extrapolate that into the future. Okay? So if the dividend yield is pretty certain, then we have to think about how do we adjust our Black-Scholes option pricing model to take into account that the option is written on underlying assets that provide an income stream. Okay, so that comes down to the question, how do we treat dividends? All right, so let's first think about the cash dividends. All right, imagine you have two identical stocks, stock number 1 and stock number 2. So they have identical cash flow and they have identical risk exposure. Okay. Now the only difference is that stock number 1, the stock return is purely realized in the form of capital gain. All right? So the total return for the stock number 1 will be purely realized in terms of capital gain. Now, stock number 2, the return will be realized in the form of capital gain plus dividend yield. If that's the case, then what we know about the cash dividend is that the dividend would cause the stock price to reduce on the ex-dividend day, right? So the dividend would cause the stock price to reduce by the amount of the dividend payments. Why? Because if the company paid out the dividend to the shareholder, then the shareholder have to adjust the stock price to reflect the fact that that amount of cash is no longer with the company. So they have to have this downward adjustment on the share price, and how much share price has to go down. It will drop by the amount, the same amount as the dividend payments, just to reflect the fact that now this amount of cash is with the shareholder, is no longer with the company. Then with the dividend yield is similar, okay? If the company pay a dividend yield, let's say the rate of Q continues to compound it, then paying that dividend yield would cause the growth rate in the stock price to be less than it would otherwise be by the amount of Q. Right? So what does that mean? So if that's the case, then we can argue the opposite. In the absence of the dividends, so if company does not pay dividends, then the share price must grow in at a rate of Q, right? Because now the dividend is with the company, so the share price has to reflect the fact that that dividend is still with the company. So the share price will grow from initial S0 to ST times the E to the power of QT. The reason why it's times the power to the QT is because that part of the income return is, so let me say this again. So the stock has a total return, and the total return can be broken into two components. First is capital gain and the income gain, right? So now if the company decides not to pay the dividends, then the share price has to take into account of that income gain. So the Q is the income gain. It's the income gain that reflected in the growth rate. So the share price has to grow from S0 to ST times the E to the power of QT. So everybody understand this, right? Does it make sense? Does it make sense? So everybody understood if the company decides to pay the dividend yield, Q, then the share price must be less than otherwise it would have been by the amount of Q. Now, that's the company decide to pay. If I say if company decide not to pay the dividends, then the share price must be grow at a rate of Q. Okay? To reflect the fact now that growth has to be factored into the share price. Okay, so that's one way to express the dividend yield. The alternative way is we can say in the absence of the dividends, the share price will grow from the amount that's less than S0. How much is S0 times the E to the power of minus QT? So E times so S times the E to the power of minus QT, this amount is smaller than S0. And that will grow at a rate of Q to ST. The reason is because in this course, we like to dealing with the final spot price to be expressed in ST. So the second alternative way is actually identical to the first figure here. It's just the fact that we start with an initial share price that's less than S0, right? And over time, we're going to reinvest. Now, if you think about if the company paying the dividend, you're going to reinvest that dividend back in the share. You're using that dividend to buy in more shares. And over time, that share would grow to 1 unit of share and with the final spot price of ST. So that's another way you can think about how we take care of the dividend yield. You're reinvesting the dividend that you received, and you're buying additional shares, right? And the one last way you can think about the adjustment is that if you're looking at S0 times the E to the power of minus QT, it's kind of stripping away the dividend from the current share price, right? Remember what we did prior with the cash dividends is the current share price subtract the present value of the dividends. Now, in a continuous time, S0 times E to the power of minus QT is effectively the same. We are stripping away the dividend yield from the current share price, and that would left us with a share price less than S0. Okay, so if we understand this second graph here, then the rest of this lecture is almost identical to what we have done in the previous week. We simply replace all of the S0 in the equation with S0 times the E to the power of minus QT. Then we can work out the option price. Does that make sense? Yeah, so that's basically what I said. The share price start at the price S0 to the power of minus QT and pay no dividend yield. Okay, what about foreign currencies? So if you think about foreign currency, if you're holding foreign currency, let's say Japanese yen, and if you deposit your Japanese yen in a yen-denominated bank account, interest-bearing bank account, and as compensation, you'll be receiving the yen-denominated interest payment, right, from that bank account, from that interest-bearing account. So the interest payment is also serving as a constant stream of income, right? And what is that income yield? That income yield is expressed as RF. So let me show you. So that income yield is RF. So RF is the foreign risk-free rate, right? So foreign risk-free rate, you'll be paid with the Japanese risk-free rate if you're holding Japanese yen. Now, if that's the case, we can replace the Q with RF, because RF in this case is almost identical to a dividend yield, right? Does it make sense? So let me say this again. If you're holding Japanese yen and you deposit your yen in a yen-denominated bank account, interest-bearing account, as compensation, you'll be paid the interest payment. And if you express that in a dividend yield, that yield is in fact the foreign risk-free rate, which is the RF. So all you need to do is to replace all of the minus Q with minus RF. So in this course, we use the little r to denote the domestic risk-free rate, and we use the little RF to denote the foreign interest rate, right? Okay, so if we understood that, then we can repeat the stuff that we learned with the underlying asset being indices and the underlying asset being foreign currencies. Okay, so let's have a look at the lower bound for the options that are written on indices, or the lower bound written on a stock that pay a dividend yield. Okay, so as I mentioned, all we really need to do is simply replace all of the S0 with S0 times the e to the power of minus qt. Then we can derive the lower bound. And the way we're going to derive the lower bound is by using two portfolios. So the same strategy that we've done back in week 4. So we're going to set up two portfolios, portfolio A and a portfolio B. So what is in portfolio A is that we're going to buy 1 unit of European coal with a strike price of X and mature in time T. And the second piece to that portfolio is we're going to buy a zero coupon bond. We're paying the present value of the face value, and the zero coupon bond would make us a payoff of X. Now, what's in portfolio B is that instead of buying 1 shares, we're buying the amount that's less than 1. To be more precise, we're buying 1 times the e to the power of minus qt amount of shares. And now, because that share paying the dividends, right? So we're going to use that dividends to reinvest that back in the share price. So over time, the share would grow to fully 1 unit of shares, with the final spot price being ST. Alternatively, you can just think that we kind of strip away the dividend from the current share price. So what we're really buying here is we're paying S0 times the e to the power of minus qt. Okay, then what we're going to do is we're going to compare the cash flow of the two portfolio, and we're going to pick the winner portfolio here. Exactly same table as what we have done in week 4. So let's have a look at portfolio B first. So portfolio B, we just bought 1 times the e to the power of minus qt amount of shares, and that would grow to ST in time T, right, in the maturity date. So ST is just whatever the market price is for the share. And then let's have a look at the strategy A. So what is in strategy A is we have 1 European coal option, and we bought zero coupon bonds, right? Now, there's only 2 situations can occur. So if the share price finishes lower than the strike price, then our call option is finished out of money, right? So we don't exercise our call option, so the call option finished with a value of 0. Then the zero coupon bonds would provide us a fixed payoff of X in respective of the market states. So if you sum up these two, you get the total payoff from the portfolio A. In that situation is simply X. Now, the alternative situation is where the share price finished higher than the strike price. If ST is larger than the strike, then our call option is in the money, and we simply exercise the call option we're making a payoff of ST minus X. And the zero coupon bonds would always pay us the X, right, in respective of the share price. So if you sum up this column, you get ST. And we see that when the share price finishes high-ish, the A is just good as B. And if the share price finishes low-ish, then the portfolio A is more superior than B, right? Because in this column here, the ST is smaller than the strike price X. So portfolio A is bigger than portfolio B in that situation. Then you just need to ask yourself, how much I'm willing to pay to get into strategy A, how much I'm willing to pay to get into B. Well, how much you pay is simply how much is the construction cost. How much it costs you to set up A and how much it costs you to set up B. We know the setup cost for portfolio A is simply one call option, and we're paying the present value of the face value. So that's C plus X times the e to the power of minus RT. And what is in portfolio B is we bought the amount that's less than 1. So that's S0 times e to the power of minus QT. Now, if you rearrange this equation, you get the lower bound for this European call option, right? And also because the call option value cannot be negative, because whenever the spot price is lower than the strike, you can choose not to exercise. So that just finish with a value of 0. So what I did is I put the maximum and the bracket. So either that or nothing. Okay? How are we doing with the time here? Okay, so let's take a 10 minutes break, and after break, we're going to have look the lower bound for the put option, and we're going to have look put call parity, and then we're going to look at some application to the binomial pricing and the Black-Scholes pricing. Okay, so 10 minutes break. Just 1 sec. Same. So take the long position in zero coupon bond is same as invest that amount of money in the bank account. Same. Yeah. Yes. Yeah. Yeah. Yes. Yeah. So basically, if you do that, you lose half mark for the risk-free rate. Then you lose half mark for the yes. Then everything else you will get mark. Okay. So everything else you will be getting the sequential mark, as if you got the correct answer. It's not right, because I told you here the capital asset pricing model is a static pricing model. Yeah, so it's not right, because the holding period is 6 months. You cannot use the annual rate to calculate something that's over 6 months. The horizon doesn't add up, right? So we start with 1st of April, we finish 30th of September. So that's 6 months time. 6 months time has to use 6 months holding rate, not annual rate. So that's not correct. Yeah. Yeah. So this is 3% divided by 2. Right? So that's one thing. you still get mark. You still get full mark if you do that. Yeah, so that's also correct. Yeah, yeah. No, I was quite busy. I was traveling. I went to Melbourne. So I visited family in Melbourne, so I haven't got a chance. Oh, I had a quick browse, but yeah. Yeah. It's quite easy to read.
It's meant to be readable by,
Yeah.
by outsiders.
Okay. Like somebody with no finance background?
You need to have
Okay.
finance background.
Yeah.
You don't need to have the technical skills. You don't need to understand financial modeling or whatsoever.
Yeah, yeah.
So as long as you have a finance literature, you understand.
Yeah. Yeah. That book is very useful. Yeah. So next semester I'll be teaching a course called portfolio construction. So that'll be helpful for me to do some practice. Yeah.
I'm taking that class as well.
Are you serious? Okay.
Portfolio construction.
Okay, okay. Don't expect too much from that course because it's my first time teaching that course, so it will not be very well structured. Yeah.
I mean, I was a reason that
Okay, yeah, yeah.
I have something to share. I can share.
Yeah, yeah. I think I'll incorporate some of that stuff to the portfolio construction. Because my expertise is in the equity market portfolio asset pricing, like factor model pricing, that sort of stuff, and how to set up like short portfolios.
So today we have also in the international finance class.
Yeah.
We have FX trade.
Really?
0.72. That's the trade.
Okay. So Ding Ding invites the
Yeah.
trader.
Yeah.
Wow.
To give us a guest lecture.
China is managing that course. I don't know much about that course. Yeah. And also I just took over the portfolio construction from him. Yeah. I'm quite worried about that course. I need to do a lot of prep during the June and July break.
So do you know what's teaching strategies do you follow?
So I'll teach some of the so-called cutting edge, or most frontier stuff that the practitioner just discovered. So I'll talk about the failure of factor pricing and what's wrong with the beta. So because if you look in carefully, high beta leads to lower return, not higher return, and low beta leads to higher return. So I wanted to talk about that. So that's called betting against the beta. So people looking into Warren Buffett's portfolio realize over the years Warren Buffett is buying a bunch of low beta companies. So that's how he generates superior return over time. Yeah. So and there's a hedge fund called AQR started implementing that into their trading strategy. And also AQR taught us something about the quality stock versus junky stock. So basically, in the conventional asset pricing is that if you're a growth stock, if you have high volatility, high growth rates, low cash flow income, then you have a lot of growth potential, but you kind of risky. Right? So if you're risky, you're supposed to provide a high return to compensate the riskiness. And if you're a safe company, growing company, provide a stable cash flow, then you don't have much risk. Then you should provide a low return, right? So that's the conventional view. But AQR people actually find out over the long run, the quality stock, those mature companies actually outperform the market. Those junky stock, those growth stock actually underperform the market. And they provide a list of indicators how you identify quality stock, how you identify junky stock. Yeah, so they do long short. Yeah.
There's a book that I want to, it's on my reading list, it's Ground Rules.
Okay, Ground Rules.
Where somebody compile all the ledgers from Warren Buffett,
Yeah.
GPs.
Okay.
Then they interpret what was the investment strategies of Warren Buffett based on the ledgers he sent to the investors.
Yeah.
So that's what book I think that talks a bit about this.
Yeah. So he always talk about economic models, that sort of stuff. Yeah.
My internship, I think one of the partners used to teach at ANU Business School.
Okay. Okay.
Construction, I think that's.
All right, cool.
He used to be something.
Yeah. Sure. Let's keep in touch. Yeah, sure. The rest of the class we're just like doing the same stuff like last week. If you're boring, you can go.
I need to review this.
Okay.
After long break, I don't.
It's almost identical time. Yeah. No worries.
All right, guys. So let's resume the lecture. So we just done the lower bounds for the call option. So the lower bounds for the call option written on currencies are also identical. We simply replace all of the minus Q with minus IF. Then you get in the lower bound on option written on foreign currencies. Okay, so then let's have a look at the lower bound for the put option. Again, we're going to use the same strategy we established in week 4 to derive the lower bounds for the put option. So basically, what is in the first portfolio C, is that we're going to long 1 unit of European put with strike price of X and expire in time T. And then because the underlying share pays a dividend yield, so we don't need to invest in 1 unit of stock. We can invest in amounts that's less than 1, which is 1 times e to the power of minus qt. And we're going to reinvest that dividend back in the share. So we're getting additional shares. So at the end of the holding period, we're getting 1 unit of share and priced at ST. Now, the second portfolio D, what we're going to do is we're going to buy zero coupon bonds that would make a payoff of X in maturity time T. Okay, so again, let's have a look portfolio D first, because that's the easier portfolio to look at. So the zero coupon bond would always pay us a fixed payoff of X, irrespective of the market states. Whether the market going up or going down, fixed income security always pay us a fixed amount of payoff X. And what is in portfolio C is we bought a put option. So if the share price finish lower, the share price lower than the strike price, then that's good for the put option, right? So our put option is in the money. If we exercise the put, basically we can selling at the X price, the strike price, and we can buy the share at a lower market price ST. We're making a positive profit of X minus ST. Now, if the share price finish higher than the strike price, then the put option is out of money. We don't exercise the out of money put, so the put option lapses with the value of 0. Now, remember the share that we bought, that's less than 1, so 1 times the e to the power of minus qt. That share will grow to 1 unit of share with a final spot price of ST, and the ST just the market price for the share in time t. So if you sum up these two columns, you realize this the total payoff from strategy C is simply X, and the total payoff from strategy C when the share price finish higher is ST. Now, when the share price finish lower, portfolio C just good as portfolio D. They provide identical payoff. Now, if the share price finish higher, then portfolio C provide us with a bigger payoff. The reason is because in this column here, the ST is greater than the strike price X. So the ST is larger than X. Then again, we need to work out what is the construction cost for portfolio C and what's the construction cost for portfolio D. Well, in the portfolio C, we bought a put option, so that's the P plus this much share. And what is in portfolio D is we bought a zero coupon bond by paying the present value of the face value. Then you rearrange this equation, you get the lower bound for the put option is simply this. Okay, again, the put option cannot have a negative value because when the spot price finish lower than the strike, we can choose not to exercise the option. So that's why I put a maximum between this expression and nothing. Okay, so that's the lower bound for the put option. It's almost identical to the lower bound for the put back in week 4. We simply replace the S0 with S0 times the e to the power of minus qt. So next week, I'll demonstrate what happens if those lower bounds violated and what you need to do to arbitrage away those price difference. Okay, so that's your lower bound for the put option. And if you're dealing with the currency, again, the lower bound is the same. You just need to replace the minus qt with minus RF. So that's just what I said. You replace the minus qt with minus RF. You're getting the lower bound on the call option written on currencies. You're getting the lower bounds on the put option written on currencies. Then the put call parity. Again, we're going to use the table format to derive the put call parity. So we're going to use two portfolios. So in the first portfolio, we're going to buy 1 unit of European call option, and also we're going to buy a zero coupon bonds that paying the present value of the face value. In the second portfolio, we're going to buy 1 unit of put option, and plus E times the power of minus QT amount of shares, so that amount is less than 1. And again, we're going to reinvest that dividend back in the share price. Then we're going to examine the cash flow of that two portfolio. So the easy way to remember this two portfolio is, first of all, if we look at portfolio E, if you're buying a call option, what else you need to do if you're buying a call option? So instead of memorizing these two portfolios, I just try to talk through these two portfolios. So first, if you buy a call option, what else you need? You buy a bond or you invest certain amount of money in a bank account, right? Because in the case that the spot price is higher than the strike price, in case that you wanted to exercise the call option, you need to pay out the strike price. So you're better off by doing something today, by save up some money today, that would allow you to exercise the call and pay in the strike. So that's why whenever you're buying a call, you always invest some money in the bank accounts. The amount is the present value of the strike price. Because in the maturity time t, that would grow to x. And x will be sufficient for you to pay the strike price. Now, the portfolio F, the way you remember this, is whenever you buy a put option, what else you need? You have to loan the share, right? Because in a scenario where you decide to exercise the put give you the right to sell. So you have to have something to sell in maturity time t. So you have to get yourself prepared for the scenario of buying some share today. So that's what we did. Once we bought the puts, we bought E times the power of minus QT amount of shares to get our prepared for the scenario of exercising the put option. Okay, so let's examine the cash flow. So let's start with the portfolio E. So if we loan the call option, if the share price is lower than the X, what's going to be the payoff? You guys tell me. So if we loan the call, if the share price ST is smaller than the X, what should be the payoff here? 0, right? So that's 0 there. And of course, the bonds would always pay us the X. So if the ST larger than X, what should be the payoff here? Yeah, ST minus X, and still we're getting the X from the bonds. All right, so let's have a look portfolio F. So we loaned a put. If the share price is lower than the strike, then the puts provide us a payoff of X minus ST, and the share would simply grow to ST. If the share price finish higher than the strike price, then the put option is out of money, so that lapse with value of nothing, and the share price will grow to ST. Okay, so you realize in either situation, portfolio E provide identical payoff as portfolio F, right? So the cash flow produced from portfolio E is same as portfolio F. In other words, the C plus X times the E to the power of minus RT must equal to P plus S0 times the E to the power of minus QT or minus RFT, right? So in that way, we derived the put call parity because we established the cash flow from these two portfolios is identical. So the right-hand side has to equal, so the left-hand side has to equal to the right-hand side. Okay, then let's have a look. How do we use the binomial option pricing approach to price the option that are written on indices, written on shares that provide a dividend yield? So the only modification you really need to do is with the risk-neutral probability. All right? Then everything else stays the same. All right? So remember how we calculate risk-neutral probability for the binomial option pricing. The original formula, the P star, the risk-neutral probability, is equal to e to the power of R times delta T, right? So we don't have this minus Q here. So back in week 5, the risk-neutral probability we used is we start with e to the power of positive little r times the delta T minus the proportional decrease, then divided by the difference between the proportional increase and the decrease. So what's the delta T? Delta T is not your maturity. So what is your delta T? It's the time length of one step in the tree, right? So delta T is the time length of one step in the binomial tree. Now the only modification is you have to subtract the dividend yield Q from the risk-free rate, right? So that's the only difference with the binomial pricing. So that's R minus Q times the delta T minus D. D is your proportional decrease, and divided by U minus D. So that's the only thing that changes with the binomial pricing. Then everything else stay the same. Then, same as before, you work out what is the expected payoff from the option by using this modified risk-neutral probability. Then you discount it back using the risk-free rate. Okay, so let's have a look at one example. Let's apply that to this example here. So it says a stock is currently trading at a price of 77 and pay a dividend yield 4%, continuously compounded. And you also told the risk-free rate is 9% per annum, compounded quarterly. So the volatility for the share price is 75%, continuously compounded. And the question says, using the binomial option pricing model to calculate the value of this 10-month American put on the stock with a strike price of $100. So in providing your answer, you can assume there are 2 time steps and 5 months each. So you split the 10 months into 2 steps, and each step takes 5 months. So you must draw a diagram, and all the knots must be labeled clearly. So first of all, we have to convert the risk-free rate into a continuously compounded rate, right? Because here you are given the 9% compounded quarterly. We know how to convert that because quarterly compounding simply means it's compounded 4 times in a year. So that's 4 times the log, bracket 1 plus, so 9% divided by 4. So the continuous version of that risk-free rate is simply 8.9%. And we're going to use that 8.9% throughout the calculation. All right, so the next thing is to calculate your proportional increase and proportional decrease. So the way we're going to calculate our little u is, remember back in week 5, so we take the e to the power of the sigma. So sigma is the standard deviation, 0.75. It's already continuously compounded. And times the square root of delta t. So square root of 5 on 12. So we've taken the 10 months, we split into 2, so that's 5 months each. And that needs to be expressed in a fraction of a year. So that's 5 on 12. And we work out proportional increase. And 1 divided by that gives us the little d, which is the proportional decrease. So once we have the u and the d, so that's your step number 1. Step number 2 is to draw your binomial tree, right? So basically the way you draw the tree is you take the current share price, 77, multiply by the proportional increase. So let me have a look. The little u we just calculated is 1. So we take this $77, multiply by the little u, 1.62. We get a price up here, 124. Then we take the share price 77, multiply by the proportional decrease, the little d, which is 0.612, and we get a share price down here, 47.45, right? And once we've done that, we repeat the same process for the remaining branches. And then we get the entire binomial tree. Then the next thing you should do is to quickly write down the payoff from the put option at each terminal point. So we have 3 terminal points. So if the share price go up, then go up again. We have a share price that's 202. Remember, the strike price for the put option is $100, right? So 202 is higher than 100. So the put option finish out of money, right? So it has a value of nothing here. Now, if the share price going up, then going down, or going down, or going up, it will finish at a price of 77. So 77 is lower than our strike price 100. So that's $23 lower. So that's the payoff from the put option, and I wrote it there. If the share price took 2 consecutive downturn, we have a really low share price here. So that's 29.24. In this scenario, we have a deep in the money put. So the put option would give us a payoff of $70.76. So I wrote the payoff here. So once we draw the binomial tree, the next thing we should do is to work out your risk-neutral probability. So as I mentioned, the only modification with the equation is we simply subtract the dividend yield, Q, from the risk-free rate, R. So that becomes the e to the power of R minus Q times the delta T. So you need to be aware of that. We already convert the risk-free rate. So the continuous risk-free rate is 8.9. And the dividend yield is already in a continuous version, so that's 4%. So the delta T is 5 months. So the 5 on 12 minus the little d divided by the difference between U and D. So we work out there is 40.18% chance the share price can go up. Then 1 minus the P star, we get 59.82. So there's 59.82% chance the share price will go down. And we're going to utilize this risk-neutral probability to work out the expected payoff of the put option at each branch of the tree. Because this is American put option, so we have no choice but to work from the right-hand side to the left-hand side at each branch of the tree. So if we start with the upper right branch, now the share price can go up or go down, right? So if the share price go up to 202, the put option is out of money. So it has payoff of nothing here. Then we don't have to worry about that. Now if the share price going down to $77, we get a payoff of 23 from this put, right? And we know the probability of that happen. The probability is the one that we just calculated. There's 59.82% chance the share price go down. Then that times the payoff, $23, and we discount it back 5 months, right? So we discount back from month 10 to month 5. So discount back 5 months time horizon. And we get a discounted value 13.26. So before we write down the 13.26 in the not B, we have to check whether or not exercising the put immediately would give us a bigger payoff, right? Because this is American put, so we can exercise the put at any point in time during the holding period. So let's check. The share price in not B is 124. So 124 is higher than the strike price 100. Right? If it's higher than the strike, then the put option is out of money. Right? So we don't exercise the put, because exercising the put in not B will lead to a loss. So we don't exercise it, we simply let finish with a value of 0, and we write down the bigger payoff, which is 13.26 here in not B. Then the next step is we work on the lower half of the branch. So if the share price go up to 77, we get a payoff of 23. If the share price went down to 29.24, we're getting a whopping payoff of $70.76. And we also know the probability of those two things happen. So we can work out expect payoff, and same as before, we discount it back 5 months at a risk-free rate. So we get the discounted payoff is 49.69, right? But before writing down on the not C, we need to check what is the intrinsic value of the put option in not C. So in not C, we have a share price priced at 47.45. So 47.45 is lower than our strike price, right? And we work out the intrinsic value of the put option in not C is 52.55, right? So 52.55 represents the value of exercising the put immediately in not C. And we realize exercising the put immediately has a larger payoff compared to holding on to this put option for another 5 months, right? Because holding on to that put gives us a lower payoff, 49.69. So we choose to go with the higher value. We're going to exercise the put immediately in not C, and we're getting a larger payoff. Okay, so I wrote down 52.55. That represents me exercising this put immediately. Then the next thing you'll do is simply work out the expected payoff, then discount back 5 months. And if you do that, you'll get a discounted value 35.43, and that's clearly higher compared to exercising the put immediately in Node A. So that's going to be our put option price, 35.43. So quite similar to what we have done back in week 5, right? Okay, then it's your Black-Scholes pricing formula. How do we adjust for the dividend yield? As I mentioned before, the only thing you really need to do is to replace all of the S0 with S0 times e to the power of minus qt. Then you get a Black-Scholes pricing formula that accounts for the dividend yield. Now, the other change is with the D1 and D2. Remember, what's in D1 is we have S0 times x, right? So we have the natural log of S0 times x, but now because we're replacing S0 with S0 times the e to the power of minus qt, then what we know is if we take a natural log on the exponential, those two would cancel out, right? So the natural log and the e will cancel out. If that cancel out, then this minus qt will come down to the front, right? So the more neat way of rewriting this D1 is we can remove that minus qt times t to the right-hand side bracket, right? If you move that to the right-hand side of the bracket, you can single out t, so the t is single out here. So what you have here is r minus q inside of this right-hand side bracket, okay? So that's one way you express this. If you don't like this expression, you can simply write down the natural log of S0 times the e to the power of minus qt divided by the strike price, and you will get the same result. So that's just the more neat way of rewriting D1 formula and taking into account of the dividend yield. Does it make sense? We just did some simple rearrangements. All right, so if we understand that, then we can use the same formula to price the assets that provide an income yield. So same thing goes to the assets, same thing goes to the currencies, provide an income yield that expressed in a foreign risk-free rate. So again, so the minus if come down to the front, and that can be rearranged to the right-hand side bracket. So that simply becomes the domestic risk-free rate minus the foreign risk-free rate. So that's the D1 formula, and you can use the D1 to work out the D2. So let's have a look how do we use this modified formula to work out the option price. So this question says, suppose the spot price to buy one Canadian dollar would cost you 95 US dollar, okay? So in this question, you are a US investor, so US dollar is your domestic currency. And you're going to use 95 cents US dollar to buy 1 unit of Canadian dollar, all right? And that's the spot price. And what else you were told? You were told the Canadian versus US dollar exchange rate has a volatility of 8%. So 8% is continuously compounded. So the risk-free rate in Canada is 4%. So remember, the 4% in Canada is your foreign risk-free rate. And the risk-free rate in the United States is 5%. Both rates are continuously compounded. So the 5% is going to be your domestic risk-free rate. And the question says, calculate the value of a European call option, the buying unit of Canadian dollar for a strike price of 95 cents US dollar in 9 months' time. So how do we do that? So as I mentioned before, if we take into account of the income yield, which is the foreign risk-free rate, minus IF, that will just go to the right-hand side of the bracket, become the domestic rate, subtract the foreign risk-free rate. Then we can use this formula to calculate our D1, D2. Then we can find the corresponding probability to work out the call option price, right? So what we were told is the spot price is 95 cents US to buy 1 unit of Canadian dollar, and the strike price is also 95 cents, right? And what else we were told? We're told the risk-free rate in the United States, which is our domestic risk-free rate, is 5%. The risk-free rate in Canada is 4%, so that's your foreign risk-free rate, 4%. So plus the standard deviation, so this is the variance, so that's just 8% square divided by 2, then times the maturity of the option, which is 9 months. So that's 9 divided by 12. And what's in denominator is 8% times the square root of 9 on 12. We get the D1 is 0.14. And then we use the D1 to work out the D2, 0.07. Okay? So that's your preliminary calculation to get your D1 and D2. Remember what we did next is you go to your statistical table to find the corresponding probability for D1 and D2, right? So let's do that. So the D1 is 0.14, right? So we go to the table where the value is positive. So 0.1 is here. Then look across to the right. We found 0.04. That is associated with 0.5557. So we wrote here, ND1 is 0.5557. Then next thing you'll do is to find the corresponding probability for this D2. So 0.7 is here, and we find out ND2 is 0.5279. Okay? So once we get this two probability, we can work out the call option price. Okay, so the call option price is, so remember, this one we replace, because we replace S0 with S0 times e to the power of minus RF. So that's the power of minus RF times the t. However, that is still your present value of the strike. So that is you're discounting the strike using the domestic rate. Here you're discounting the share price using the foreign rate. So don't be confused, all right? Now we know what the current spot price is, so that's 95 cents. So we're discounting that with the foreign rate. And we know the probability for ND1, that minus the present value of your strike price, that is discounted with your domestic rate, 5%. And also we know what's the probability for ND2. So we work out this call option should be priced at 0.029. So any question on this particular one? Now, if you came across with optional indices, you simply replace the minus RF with minus Q, and then everything else stay the same. All right, so the last bit for today's lecture is portfolio insurance. We've done portfolio insurance back in week 2 using the futures contract. So this particular question asks us to set up an insurance on the portfolio using the options. So let's have a look at the question first. So this question tells you that the portfolio manager can use the index options as insurance to hedge against the downside risk of their portfolio. So consider if you're the manager of a well-diversified portfolio that mimics ASX 200 index, and your portfolio has similar return and a dividend yield to the index. And what's more is you were told the percentage change in the value of your portfolio can be expected to approximate the same as the percentage change in the value of the index. In other words, your portfolio has a beta of 1, right? Because your portfolio mimics exactly that of the market portfolio. So your portfolio has a beta of 1.
Then what else we know? So you're given the multiplier, so the points needs to be multiplied by $25. In the final exam, I will not give you this information. If you are given with American indices, I'll tell you otherwise what the multiplier is. But by default, it's 25, right? And what you're required to do is, okay, so another thing is you were told the portfolio has a net worth of 100 million, and the value of index is 5,000 points. The volatility of the index is 25%, risk-free rate is 9%. So the manager wants to hedge the portfolio for next 3 months. Dividend yield on the index is 5%. Put option can be bought with a strike price of 5,000. So the first question you ask, how many options the managers need to purchase in order to fully hedge his exposure, $100 million exposure. And the second question is, how much would this insurance cost? All right, so in order to work out how much the insurance would cost, we need to work out the put option price. So first, let's have a look how many contracts we need. The formula to work out how many contracts we need is same as the formula that we used in week 2, where the instrument is futures contract. So basically, you just ask yourself 2 questions. What is my exposure? In other words, what is the amount to be hedged? So you were told the amount needs to be hedged is 100 million, right? So in the numerator is 100 million. And then the second question you ask yourself is how much per contract is covering? So each contract is covering 5,000 points, and that needs to multiply by $25, and that amount needs to be adjusted by your portfolio beta. So in this question, it's very convenient. Your portfolio beta is 1, so identical to the market portfolio. So you need 800 contract, put option contract to hedge your portfolio, right? So this formula is identical to the formula you learned in week 2. All right, next thing you need to do is to price this put option. You have everything you need to price the put option. For example, we know the spot price on the index is 5,000 points, right? So that information is given. And also we were told the put option provided you a strike price of 5,000 points. So the X is equal to 5,000. And the risk-free rate is 9%. The dividend yield is 5%. We also told the standard deviation is 25%, so that's 25 square. And the time horizon, 3 months. So 3 on 12, we can work out the D1 is 0.14. But remember, in this time, we are pricing in a put option. So the inputs for the put option is N minus D1 and N minus D2. So you have to put the minus sign in front of D1, and you go to the table with negative figure, you'll find the corresponding probability with negative 0.14 is 44.3. Okay? Then you use the D1, you get to calculate your D2, 0.02. And again, we need minus D2 to work out the put option price. So we go to the table and we find the corresponding probability for minus 0.02 is 49.2%. Okay? So we write down this 2 probability, and we have everything we need to price this put option. So that's just the present value of the strike price. So that's us discounting the strike price of 5,000 points, then multiplied by N minus D2. We found out from the statistical table. And here we're just stripping away the dividend yield from the current points, the current spot price, which is 5,000 points. So the dividend yield is 5%, multiplied by the probability associated with minus D1. So one thing you have to bear in mind is that all the inputs is in points, So this value here, 211, that's in points, okay? But always convert your put option to a value, to a dollar amount, okay? So the way to do that is by multiply by $25. And how much contract we have in place? We have 800 contracts, right? So that's the points multiplied by $25 multiplied by 800 contracts. So we need approximately $4.2 million to hedge our $100 million portfolio. It's quite expensive. And the last point is ask you to show this insurance strategy actually work. Now to do that, you just need to demonstrate what happens if the index has fallen. So here I just hypothetically say, what if the index dropped to 4,000 points? Now, if the index dropped to 4,000 points, our portfolio will be dropped by the same amount because our portfolio has beta of 1. So in this case, we don't need capital asset pricing model to adjust for the return on the portfolio because the market return is just our portfolio return. So if the index dropped from 5,000 to 4,000, then our portfolio value will drop from 100 million to 80 million. So that's $20 million loss in our portfolio. But that's okay because we are making money in the put option, right? So what's the payoff from the put option? The payoff from the put is always X minus the spot price, right? So the strike price is 5,000 points. The current spot price is 4,000 points. So that's the payoff. And that needs to multiply by 25, and that needs to be multiplied by the contract size 800. So that gives us a gain of 20 million on the put option. So if you combine these two amounts, your portfolio sum up to be 100 million. But you need to subtract the cost of setting up this insurance. What is the cost? The cost is 4.2 million, right? So 100 million minus 4.2 million, the net worth of your portfolio 3 months later is 95.77 million. Okay, so any question on the portfolio insurance? No? Okay, so that's all for today's lecture. And remember to go to your allocated tute to view your exam script. And also we have a quiz on binomial pricing next week, all right? No, the quiz will be the binomial tree. But they're the same, right? So they're the same.
Yeah. So is that for week 5?
Yeah, week 5.
Oh,
yeah.
Okay, thank you.
我在那个 club，就是排名更后面的，就像 Z X Y Z。